Lyn, you referenced Ray Dalio. I believe he's cited four ways that countries or entities can deleverage from a long-term debt cycle. The first is austerity or cutting spending. The second is a default on the debt or some sort of debt jubilee. The third is redistribution of wealth by taxing the wealthy and using that to fund the deficit. And the fourth one is inflation. My question to you is, Lyn, in your paper, you cited another study that 51 of 52 countries had effectively defaulted on their debt, either by inflation or deflation. The one that hadn't is Japan. So my question is, of the 51, how many of them did it via inflation, via a true default, via wealth distribution? And then what can we learn from Japan, if any? What did Japan do that the other 51 countries did wrong?
So the majority of them did so through inflation, where basically you had much higher inflation relative to yields. Now some of those were hyperinflation, other ones were just moderate inflation that was well above the yields, and so you lost money on a real basis if you were a holder of that debt. And whereas emerging markets, or other countries like Weimar Republic that owe liabilities in currencies they can't print, they're more prone to nominal default. And so that's kind of the big difference between those two. As far as Japan, what made them somewhat different is they, as I mentioned before, they're like a very large creditor nation, and so they went into that stagnation. As a very, they had such a strong set of decades, and they built up such a reserve that it's kind of like going into retirement, but having saved millions of dollars from your time working. And so they were kind of relying on that nest egg they built up. And so, they ran into issues and they did a ton of quantitative easing. They effectively monetized very large portions of the debt. But, because they had that constant source of foreign income, it helped keep them more stable than they might have otherwise been. In addition, you had, a set of policies in place so that they have among the lowest wealth concentration out of developed countries. They have rather high levels of say, public harmony, you can call it. So no country is obviously gets along on everything, but if you measure populism or partisanship in different ways, Japan is less, say, polarized than the United States and some other countries. And so that combination has kind of allowed them to weather that storm. Now we're starting to see here in 2021 that Japan's running into some headwinds because they're a big energy importer and energy costs have gone up a lot. So we'll see if that carries into the 2020s, deeper into the 2020s or not. So I would say going forward, I'd be less, calm about, say, holding Japanese government bonds than investors might have been over the past 15 years or so. But either way, basically, the study shows that the probabilities of success when you're holding government paper with debt as a percentage of GDP as high as it is now tends not to be very high. You basically have limited upside but considerable downside unless you get one of those rare exceptions like Japan combined with commodity abundance combined with globalization and a bunch of tailwinds in your favor.
Lyn, you've got some fantastic charts that we have to get to before we end. This one really gives a great illustration of your point. The blue line is a U.S. corporate debt.
That's percentage of GDP, yes. The blue line is corporate debt as a percentage of GDP, and the red line is interest rates.
Yeah, so the way to keep the wheels spinning is to have debt increase, the blue line, or to have the red line, interest rates, decrease. But it looks on this chart, at least the way it's figured, that the blue line can't really go a lot higher and the interest rate can't really go a lot lower because we're at what, 0.06 for the federal funds rate. So can the red line go lower? Can we have negative rates, and can the blue line go even higher?
So Europe showed, for example, that you can have mildly negative rates to some extent, especially if you're running current account surpluses, if you're more deflationary than some of your peers, you can pull that off for a period of time. But you can't just go deeper and deeper and deeper into negative territory because eventually the banking system starts falling apart. Eventually, people will, basically pull their money out and hoard cash if it means, having a zero rate over, say a -4% interest rate or something like that. And so, down to maybe -1% they can go, but it's much harder to go lower than that. So I would say that once you reach roughly the zero bound, that lever starts to become less and less available to central bankers, and they start to turn into, some more inflationary aspects like fiscal stimulus and these other policies that they tend to turn to in those types of environments when they run out of that room.
Well, I actually, so definitely the red line, it's very tough for it to go lower than zero. And it is very unlikely that it will be super productive. What about the blue line? Can the blue line go higher? I'm looking at another chart that you have of countries ranked by debt, and the U.S.'s corporate debt as a percentage of GDP is somewhat high, but it's actually, a fraction of what China's is, right?
It certainly can go higher. Whether or not it will go higher, I think is a different question. You never want to say that something is the absolute top, especially when we can identify other areas. Like, for example, Japanese, say, public debt as a percentage of GDP certainly has gone higher than the U.S., say, government debt to GDP, and China's corporate debt has certainly gone higher than the United States corporate debt. But when you do reach the zero bound, you start to run into headwinds going higher, at least in terms of private debt. And so if you look at Japan again over the past several decades, they've kind of transformed some of that private debt into public debt. That's kind of that conversion they've gone through. And so that's the type of thing you generally start to see when you reach that zero bound, where it gets harder for private debt to keep going up. It might even go down. And so a lot of that starts transferring to the public sector based on, different fiscal policies that they might do.
So, Lynn, a final chart I want to put up for you is such a great one. It is the view of different devaluations. You say that the devaluation of the 1930s was non-inflationary. Of the 1940s, it was inflationary. The devaluation of after 2008 and the green bar over here, the green circle, was non-inflationary. In this red bar, why do you think that this will prove to be inflationary?
Mainly because you're getting very large fiscal deficits, basically driving up broad money supply at a much quicker rate. And then you throw in commodity shortages and periods of deglobalization. And so during the 1930s and the 2010s, you had what I refer to as a non-inflationary devaluation because you had commodity abundance, you had economic stagnation in relative terms. And so you had, in 1930s, they devalued the dollar relative to gold. In the 2010s, you did quantitative easing, but that did not manifest in dramatically high, say, CPI. It might have manifested in asset prices going back up, but not necessarily commodity prices and things like that. However, when you work that off for a full decade, and then you enter a period of commodity scarcity, and things get bad enough, the government start doing those large fiscal spending programs, you get a more inflationary type of environment, and then they're forced to hold yields low because the debt's so high. And there's a couple different ways that they can do that. That can be either more or less inflationary than others. But basically, the odds start to go up dramatically of an inflationary environment. And so that chart, for example, predated what we have in 2021. I put that chart back together in 2020. And so we have seen here in 2021 that some of those inflationary aspects have started to play out.